guys are unable to find good use of every information that you see online, because all those informations you see, they are half-baked. But I'll be trying as much as I can to explain one of the important things, right? One of the important things that anybody that is trading would be able to understand. Okay? Be it you are trading a retail way of trading, be it smart money, be it external to internal liquidity, blah, blah, blah. Even despite the fact that external to internal liquidity, now that all of you now, you are shouting up and down. If I show you my 2000 or 2001 course, you will find it there. Exactly what everybody is hyping these days. You will find it there. I've been trading this thing for over 3 years or 4 years now. But people just come, die minutes, start capping nonsense that like making it feel like it's a new discovery. So it's not a new discovery. And as for me, like this, when it comes to this market, I really understand it. So I'll be explaining something very, very important to you guys so that you would have a very, very better win rate. Okay? Because most of you guys are not really consistent with your system yet. And still, you are not still a conservative trader. What I mean by that is, let me start by using the popular external to internal trade for an example. Everybody we are used to this, that when market does this, we see this as an external liquidity. And miraculously, we felt like market needs to get here and sell. It works, right? It works. In fact, it works very, very well. But most of you guys, if it truly works and it is that easy, then almost everybody should be profitable by now. So I'll be explaining a very, very simple psychology behind these things for you, and a way to be much more conservative. Because why would you have a setup like this, and again, you have another one like this? The same pattern. And then you have this. And this one, you took a loss on it. So how would you know? Most of you guys are trading without variables. You are trading without checklist. You are only trading patterns. You don't even know what you are doing. All you just have to look for is, once you see your shoulder, your head, you just think this is an inducement, then boom, market just has to sell, just like that. You just start getting limit there, and you keep getting bonds, because you don't even need to tell me. Almost everybody is getting bonds. If not, everybody among you should be profitable. So I'll be explaining how you can be much more conservative on this, and with the psychology behind this pattern itself. I'm going to be explaining to you guys in a very, very layman explanation. Now, this only strategy, how does it work? What is the psychology behind it? Now, like I used to say, there's two types of pullbacks, right? There's a complete pullback and there's an incomplete pullback. Now, what is a complete pullback? This is not about smart money here. This is about every strategy. So, what is a complete pullback? Is when we believe, in our basics, we believe, who is this? I'm coming, guys. Yeah, I'm having a session now. Go to my public group. You will see a link there. Join, so you can also join. So once I'm done, I'll talk to you. So sorry, guys. Mr. Picture, not hear me, sir. Okay. So now we all believe that. Now they said when market creates a swing, market will retrace, market will buy. This is the textbook thing that we know. But there's something here that is fact. It is, they said it when you read your baby pips or whatsoever, that market needs to pull back to at least 50% of the initial move. What is the 50%? To measure your 50%, it is from year to year, right? So they told us that once market pull back to 50%, that simply means what? It means this pullback is complete. That is the type 1. So what is now an incomplete pullback? With this, an incomplete pullback is when markets now break structure, pull back, but not up to 50%. So this is your feed from this low to this high. So not pulling back to your 50%, this swing, this low to this high is not considered as a new swing because this guy is not a complete pullback. So not being a complete pullback, that makes this guy what? Fake. And why is it fake? Now, let's ask ourselves, why would the market know that for a complete pullback to happen, it needs to pull back to 50%, but miraculously, it came close to the 50% and refused not to get to the 50% and buy? What is the market trying to do? The market is trying to haunt some certain people, or it is trying to induce. What is the meaning of induce? If you put it in your Google now, induce means when you are trying to deceive someone. You know, when I say I am trying to induce that babe, you know, say if you induce babe, normal. So if I tell you that I'm trying to induce a babe, you know me, it means I'm trying to deceive that girl just to collect pants for my yash. You understand? Most of you, they induce babe, normal. You telling a babe that, babe, how far? You are the only one I love. I cannot do without you. You are inducing the babe. Because you know you are lying, but you just want the babe to fall into that trap, then boom, you are going to eat the take profit. Once you eat the take profit, no, you are going to take the babe stop loss. Once you take the stop loss, then you are going to jackpot. So that is inducement. Because inducement, it means trying to fake you, trying to deceive you, right? So now, this is a complete pullback, one, and this is an incomplete. Now, we now also have, this is the basic one. We now also have a situation whereby market will pull back to 50%. But it is still going to be what? An incomplete pullback. This is the basics. So you will be like Kama said, when market pull back to 50%, it means pullback is complete. But there are some situations whereby market will pull back to 50%, but it is still an incomplete. That is where your fair value gap comes in. Because what is fair value gap? We all believe that for a market to be called a market, there have to be a presence of buyers and sellers. Everybody know that. There's no way you will call a place a market without buyers and sellers. So what will now happen if there's only buyers in the market? That means that market is inefficient. So for that market to be efficient, a seller needs to be introduced. So, and we know that it actually costs billions of dollars to move price. So now, if there's an imbalance here that needs to be filled, then this guy came, refused to fill the imbalance, then buy. That simply means, why would the market buy when there is a billions of dollars here that the market has to mitigate? So why would they ignore it? So the ignoring of this fair value gap that the market could have just come and fill at once when it was close to it, that means this push is also what? An incomplete pullback. Because a valid pullback is for market to complete its cycle. And completing of a market cycle is when market fills a gap or when market targets an external liquidity. So now, this is the type basic, this is the little bit advanced of incomplete pullback. I am still going back to this thing. I'm just trying to explain. Because people that know me, I don't just tell you what to do. I tell you my thought process on how I go about it, right? So now this is the second type of incomplete pullback. So how do you use this to your advantage? So now let's go to the holy grail that all of you now you keep trading. In fact, some people actually kind of make it seem like it belongs to them. But it's funny, everything is on the market. It's just you that need to just sit down and study it. So now let's use those information to explain this holy grail right now, which is this. So the type 1 is what? Incomplete pullback. Then what? Inducement. Then you are expecting this to happen. This is your type 1. Type 2, incomplete pullback, type B. But the market will still come, take it out and sell. So now, this is the common one. I am not really going to go too far in how you are going to get in on this trade directly. I'm not going to do that. But I'm going to be explaining how you can be so conservative and you will make a lot of money. That's what I'll be doing. So the conservative part of this trade is, remember, if you guys have been following me for long, I used to say a word, which is the closest point to inducement. That is where you should be taking your trade from. And there's a reason behind it. Because every move that the market makes, there's always a consequence for it. For real, every move the market takes, there is always a consequence. Now, what do I mean by that? And every valid point that the market ignored, it would be served, it will turn to a trade zone. Every point that the market ignore, every valid point that a market ignore would be used or can be used against you later. What do I mean by that statement? Now, we have a high, a low, a high. Now, markets come here, pull back, then drop. Now, you have your extreme POI right here, which is far to the inducement, right? And you have another one here, which is close to the inducement. Now, some of you will set limit here. You will set limit here and set your target here whatsoever. Some of you will set it here and set your target here. And some of you will set it in the boat. Meaning, if this one fail, I will kuku use this one. But that is a very, very dumb way of trading. A very, very dumb way. So I'll be explaining something now. So I want you guys to pay attention. If there is no 2 point of interest in this range, if you don't have your reclaimed block right here, and also your extreme right here, you can set limit on one and lock up. But anything that makes you have two, or anything that makes you see that your POI is far away from this inducement, there's the way you can get in on this trade in a very, very professional way. And what would you do? How would you go about it? Now, let's say you have two POIs. Once markets come, I want you guys to pay attention. You have, what is it called? You have your supply here. So the market come. Remember, let me draw. I need to draw this thing very well. Let me draw. I want to draw it very well. I'm sorry, I'm coming, guys. So you have this. So you have a POI here. So having a POI here, and you have an inducement here. Remember, it is because you are much more informed than the other. That's why you know that this guy is an inducement, right? But some people does not know that. They see this as a supply. So you will be using these people to validate your analysis. And how would you do that? Now, markets come to their supply. It would react. Once it reacts, market will take it out. So once market take it out, there's two things to be expecting from this market. It's either markets come here, reclaim this violation block and buy, or markets come here and sell. So how would you go about it? Are you just going to be gambling the sell that, okay, hopefully it is going to sell? That is not a smart thing to do. So a smart thing to do is this point right here is your what? Once market trade above your inducement level, fuck the POI. Fuck that POI. Right? Fuck this POI. I don't give a fuck. Once market take out these inducements, what are you interested in? This decision point. This is your decision point right here. And you know that this decision point can make market go up or market would go down. So what are you expected to do as a trader? Number one, you already know your bias, which means you are looking to sell. You already have that at the back of your mind. So looking to sell, you want this decision point to be what? To be invalidated. Once it gets invalidated, then you can sell perfectly from any point once market has pulled back to 50%. Like any point. Once market has pulled back above 50%, you can sell. It's not a must you use other block again. You can sell anywhere. This is the entry type 1. What is the entry type 2? That is when the market decides to do a drop-based drop. And what is a drop-based drop? Market will come here, act like it wants to buy. Then what? Take it out. So the taking out of it, then this guy would be your what? Your entry. This is a very powerful and conservative trading model for a beginner or for an intermediate trader that needs an edge. You enter from this base and you what? And you target your external liquidity. This is your major target. So once market take out this guy, let's not assume that you have a long-term target. There are two things you have to do because the rule is what? External to external. So this whole setup is for what? Is to complete this rule. So once your market gets here, there are two things you should be thinking of doing. Tap it. It's either you take partials or you close all your position or you break even. You don't leave your trade open after tapping into this guy because this trade has met its initial purpose. Any target after external to external is an expectation. It is not fact anymore because the market has done what it needs to do. Now you they expect say it has to go far, which it can go far, but you have to secure yourself. Either take partials or break even or close all your trade. It depends on the rules you want to follow. That is that about this simple one. Now, let's now go to much more tricky one. A situation whereby you have two other blocks. When you have two other blocks in the range, what did you do? You have order block 1, order block 2. Remember, I said any valid point that the market ignored is already what? A threat zone for you that you need to be careful of. So, let's say market get to your first one here. You are waiting for a confirmation. Then the market does this. Boom. Then it got here. It gets here. Don't ever try to what? Let's say market even did this. Don't ever try to just set your limit here. As a beginner, don't do it. As an intermediate trader, don't do it. Why are you in hurry? Why? So what you can do in this scenario is simple. Once market broke this structure here, it will make some people think, or let me just put it this way, don't let me go there. I'm coming. When market did this, right? Let me assume it to be like this. A market broke structure here. So when market broke this structure, Hey, sorry guys. When market break this structure here, what does that imply? A lot of people will feel like, oh, market has taken out my inducement and it wants to sell, right? So they want to sell from here. I'm sure most of you might be like, yes, now, does that not make sense? They want to sell from here. Fine, no problem. Now they shop loss, which is not a big deal. Now market react a little bit and take them out. Tap into this guy. So if you say you want to sell from here, you have to remember that you already have a trade zone. And what is that trade zone? You already have this guy, which is a decision point, because it is a violation block that took out this high. So market can come here and what? Decide to buy. So you have to think before all the possibilities that might happen before you take your trade. So for a smart trade, what are you expected to do? You are expected to wait for the market to take out the decision point, like I did in the first one. Once that decision point is being taken, you draw your fib, you put it there. I'm not even talking about other block now. You draw your fib, you put it there, you wait for market to trade above 50%, then you sell. This is a trading system you can use over and over and over again. External to external, internal to internal, everywhere on the timeline. I just dey laugh. Because there's things you need to consider. If you want to trade directly from here, there are things you need to consider from this eye to this eye. There are things you need to see for you to know that, okay, this eye is valid, for you to set your limit. It is not just because you see ABC pattern. I'm not going to cap for you. I can tell you that I am one of the people that simplify this strategy. This is not even capping right now, because this strategy, if you guys have been following me, I labeled it ABC pattern. That's what I used to call it. A, B, and C. That is what I used to call it. And I said the B leg is your inducement. But for a beginner, or for somebody, not even a beginner now, for an intermediate trader that needs an edge, don't just be marking one kind of head and shoulder. Yeah, just think whenever you see this pattern, market will just respect your head and shoulder and you will sell. Don't stress yourself. You are not being reactive. You are predicting. And for you to be consistent, you have to be reactive. This trade here has nothing to do, even if it respects your trade, it has nothing to do with your head and shoulder. There's a psychology behind everything, right? But you have to make sure it is not just the pattern that you are focusing on. But for somebody that is just starting up, you are still trying to get a stand for yourself. Be more reactive than being predictive. Because why set limit here directly when you can wait for price to give you either of all these confirmations that I've told you? Why? Because market will just come, take you out just like that. And now, why would you risk your money on something you cannot manage? Think about it yourself. Why would you invest your money on something you cannot manage? You just spot a pattern and you put your trade on it. Is that how to? That is not a smart investment. Because every point you mark, every analysis you make is a what? Is an anticipation. Once you have your anticipation, then you need the market to validate what you are anticipating. Because market cannot just get here and just fly to TP. It's only if there's news. There are some price action that market would print. So why not wait for those price action? And these two that I just showed you here, they are like few of the type of price action you should expect. This is how to have a system. So you can trade as much pay as you can. Spot this your pattern or whatever pattern you are trading. Any zone, even if it's the head and shoulder that you mark, even if it is you, you know how to mark fair value gap. Even if it's you, you know how to mark other block. See that point as your point of interest. And for every supply, because I made a video about break of structure. If you think this guy is an inducement, but think about it, what if it is now a break of structure? That the market just did this, then it stop you out. Always think about what if. What if? You only think it's an inducement. You thought, not the owner of the market. What if it's a break of structure? So until when will you keep taking trade based on hope? If you have a POI and market start to do some certain things in your POI that align with your bias, it makes you feel good. It makes you more confident in that trade because you are already following the storyline. Because now you have your POI here, boom, market tapped your POI. After that, market took out the decision point right here. Then it created an imbalance, or it gave you a head and shoulder, or it gave you a fair value gap. You already be telling yourself like, okay, I think I am right. Because market, why would market tap into my POI and it breaks structure and it invalidates? It's now making sense. The market is now following your expectation. You don't just set limits because you have seen an head and shoulder that have an inducement. You don't just set limits there. And if you want to set limits, you need to get more information. There are things that need to happen from year to year. From this previous swing to this swing, there's things that need to happen before you can trade this guy. Not just all about the pattern. Fuck the pattern. If it's by the pattern, everybody will be rich. So, I know if all of you guys that are here are profitable, you are most likely not to be here. You are not profitable. That's why you are here. And I'm telling you, you have to be much more reactive than being predictive if you want to make money in this game. The reason why I'm using this as an explanation is because it is the new popular stuff. And every information that I've been seeing from most people, it is incomplete information. They just tell you to start looking for the pattern and you are expected to be making money. They play. They play. It's incomplete. It's because most of them just, they heard it from someone. They didn't really get the right source of the information. So that's why everybody just come and start marking external to external, internal to internal. Your body could tell you. Your body could tell you. You think it's by pattern? If it's by pattern, why don't you just go and print all this pattern and gum it in front of your trading station and be trading the pattern and be printing money? Think about it yourself. You must have variables. Your trading system must have a checklist. And you must know the difference between a trigger point and a point of interest. Because you see a pattern does not mean you have to set a limit there. Follow money transfer. Follow order flow. Let market dance to your tune. What is your tune? Your tune is your point of interest. Let market get to your point of interest and tap into it. And start to tell you that, okay, I am following your story. So that is when you will be like, okay, I think I might be right. If you follow this thing now, you will see less trades because you are being reactive, not predictive. You don't just see a pattern and set it. This has nothing to do with SMC. You can trade this same pattern, this same thing, this same storyline with any strategy. You can trade it with key level. You can trade it with head and shoulder. You can trade it with trend line. And I can explain it. Now, let me explain. If you want to trade this thing with head and shoulder, this is your head and shoulder right here. Shoulder, head, shoulder. If you want to trade it with trend line, how would you enter? This will have been your trend line. You draw your trend line from year to year. And wherever the third one meets, that is where you are going to be entering your lower time frame confirmation. If you want to trade it with key level, what is key level? A key level is a point that the market keeps testing over and over again. So look at this guy. Market tap into this guy, it's bought. He tap into this guy here, it's sold. Then this point will be your next entry point because you have a key level right here. So this has nothing to do with your order block. You can trade it with any system, but you just have to wait for the proper trade zone to be invalidated. Okay? So you can use your trend line, you can use your head and shoulder, anything works. But know the difference between trigger points and point of interest. Don't just say, see, it's not necessarily means it has to be this type of liquidity. Any liquidity that you find, your expectation is once market take out that liquidity, once market take out that liquidity, the market needs to sell or buy. So now let's assume this is the type of liquidity you have. Equal highs. It is still the same approach. You just want to see how this guy is being taken care of. So now, market come, get to this guy, react. You don't just say because it is equal highs, you just set limits. No. You wait for this last decision point to be cleared. Then you can sell. But for people that are well informed, they know why they can sell from here, not just because of your order block. Fuck that. But if you are not, you don't need to stress it. Just wait for this guy. And remember, there is a difference between this guy. If this guy broke this high before pulling back, there's a difference between this and this. So there's different though. Market can do this now, and it's not going to sell. It will take you out though. Because remember, this guy now is now also an external liquidity. So it can just come like this and clear you out. So know the difference between this and this. They are two different things. So that's why I'm telling you that it is not by pattern. It is not by change of character or whatever you guys are talking about. Mr. Pick, I don't go too much. Mr. Pick.
Yeah,
Mr.
Pick. Yeah, I'm here. Can you hear me?
Solo Yagbeni.
No, I'm here. I've been listening to you. Okay. No. I'm inside my office, but it's just I've not padded it yet. So
I thought stabilize I don't go too far, so may I rest too.
Yeah. So just you can just try to maybe show them one example on charts. Then let's end it and I'll take over.
Okay, yeah. Let me use my trade today. I'm coming. Let me use my trade today as an example. No. Okay, not this one. So now, look at this Euro USD now. I knew that this guy is an inducement. Right? So this guy being an inducement, let me mark it as a supply. So where is the decision point? The decision point is this guy, because it is the last sell that happened before what? Before this market bought. So instead of setting my limit here, I'm talking about you people, not me. Me, I know what I would do. Instead of setting my limit here because of one kind of head and shoulder, and putting my target here because you feel like you are the market god, I would rather wait for this guy to be violated. So now that it is violated, I now know that, okay, the market has taken out my decision point to the bearish side. So what am I going to do? I am going to what? Take my trade from here. Follow me. This is how I do my ping pong sometimes. I follow my trade from here. I'm talking about you people. You take your trade from here. You put your stop loss wherever you want to put it. Then the stop loss reasonably should be this high or whatever, wherever you care. So where will be your target for this trade? Most of you will set your target here because now you're the game market. But remember, market broke structure, you pull back here. This is the reasonable target that the market needs to do, which is creating a new low. This is your reasonable target for this trade. Now, I took that one. Using the same model again, This is my inducement again. Why? Because I know that there's an incomplete price action here if I go to lower time frame. So now, where is the decision point of this inducement here? This inducement here now, where is the decision point? The decision point is this candle. Because this is the last sell that happened before this market bought to break this structure. So now, what are you going to do as a trader? You wait for that decision point to be broken. So once it got broken, like I told you, you can use whatever thing you want to use. So now this is a what? Order block. So from that order block, you pick your entry from it. And what will be your target? This is where you are going to break even. Once market creates new low, you are going to break even here. But using the rule of external to external, if this is the inducement, then this is your target, final target. Then after breaking even here, or whatever decision you try to do, probably break even, take partial whatsoever, then you are going to put your final target at this guy. Now, the same thing happened again here. Market has taken out this inducement, but the market has closed already. Where is the decision point for this trade? The decision point for this trade is 2. We have this guy, 1, and we have this guy 2. Why is it these 2? This supply is being respected with this price action. But this swing here is being violated by this price action. Sorry, by this price action here. Which means you can take a conservative, a aggressive entry by expecting this to happen. Or better still, you wait for this guy to be broken, then you wait for a pullback, then you sell. That is how to go about it. Over and over and over and over and over and over again. I'm using today's approach. Now, using the same thing again. This guy is an inducement. Right? A lot of people mark it. Now, where is your decision point? This is the last sale. I'm coming, guys. Oh, sorry. Let me delete this guy. Where is your last sale before they took out that eye? It is this guy. So, when are you going to start looking for a trade? Once this guy has been taken. So, when this guy got taken, you can use whatever confirmation you want to use. Either you use your fib from this high to this low. Once market pull back to above 50%, you enter your trade. Or you can use your head and shoulder. Where all of them they call Quasimodo. Now your head and shoulder be this for here. You can use your head and shoulder. You can also use key level. What is key level? You can see that at this zone that I marked, when market got here, it sell. When it got here, it sell again. When it got here, it sell again. So this one, it trade above it, we serve as a manipulation. So now that it broke it below, you can use that same point as your what? As your entry point. That is that about that. Now, what another confirmation you can use again? You can also use trend line. So using trend line, once this guy is broken, how are you going to get in with your trend line? You are going to plot your trend line from year to year. Then where is the third touch? From here it's bought, from here it's bought, from here it reacts, from here it's sold. Then look at it here. You can see. You can put your entry right here. So no strategy doesn't work. You just have to be in the right place at the right time. You can see that I just used like over 5 different strategies to explain one entry now. So this has nothing to do with SMC, with what I'm explaining to you guys. So do I make sense, guys? Shame or make sense? Do I make sense, guys? How will I even know if I make sense?
That makes sense.
So that is that about that, actually. So thank you very much. I will still stick around if I need to talk. So Mr. P can take over now. So thank you very much.
All right. Thanks a lot, Mr. Kama, for that wonderful session. I really, really appreciate. For everybody here, please don't forget, I told you that at intervals, ensure that you maybe take screen record or just record with another phone or just take snapshot so that you can actually tag us at the end of the the session. All right. Kama has spoken quite well. Okay, and I'll just try to chip in one or two. I'll just try to chip in one or two. Okay, so that we can further still understand the simple concept that we are actually trying to pass across to you. All right, very, very important. Okay, let me share my screen. I know that some of you might have questions. I know some of you might have questions. All right, so I believe you guys can actually see my screen. So the model Kama has told you about is a very, very simple model, okay? And the most important thing that he actually said there, right, which I'm very much interested in and I've actually been using, okay, is you being reactive to the market. You have to be reactive rather than being predictive, okay, so that you don't get caught, or so that you can reduce the amount of times that you get caught. All right. Like I said it in the last video that I did, where I was explaining the Euro GBP USD trade that I took that hit take profit today of over 21 hour. Okay, most of the entries that were there were some entries that are fine, took me out, okay, because of the fact that I had variables. It's very, very important. I told you guys in that video that once price is approaching a supply zone, in quotes, is approaching a supply zone, a lot of people have it in their mind, right, that price will actually sell, okay? Lots of people have it in their mind that price will sell once price is approaching a supply zone. Whereas, as a trader, you should understand that a supply zone, for example, is a decision point. It's a point where you should be interested in executing a trade. Okay, it doesn't really mean that price must sell at a supply. Most people, when they mark out supply, they want price to sell. Okay, I said that in that video. But the truth of the matter is, you have to ensure that once you have a zone, you want to be interested in what price will do around that zone, okay? Because most times the reason why we call this, or we say the concept early buyers and early sellers, is because of what price tends to do around a POI, such that price tends to engineer more liquidity, okay? So that we can have early decision makers, people that will quickly want to sell from the zone, or people that quickly want to buy from the zone, okay? And then eventually, okay, the patient people will now eventually trade. All right. Now, just to buttress one thing that he said, let me just give you this simple pattern of inducement that lots of people trade, okay? I talked about this pattern, right? Now, if anyone has watched a video that I did on valid pullback, all right, if anyone has watched a video that I did on valid pullback, right, where I use that video to explain, okay, when a certain movement is actually complete. Now, I like I said, whenever I teach, I don't like using bogus grammar, okay, because I said something today that in my Twitter, where Einstein said that if you don't, or if you can't explain something simply, it's probably because you don't understand it enough. So I try as much as possible to use layman language, or to use to explain charts as simple as possible, so that even if your rate of assimilation is actually slow, okay, you can still try to actually get it. All right. Where I try to explain the concept of inducement, right, as valid pullback. There was a time I said something about that, right? I said something about valid pullback, okay? That I said, okay, let's say we are having price move in a certain direction, okay? Where I said that how to know if a certain leg is complete, okay, is if the last significant high or the last significant low is taken out. Now, that last significant high is the B that Kama talked about. You know, Kama said this is like an ABC pattern, where here is A, giving you an example. Because it's not like maybe we trade the same thing, okay? But the fact that we have a profitable knowledge simply means that things will align, okay? The Forex trading or Forex trading world is more or less like the same language, right? At a certain point in time, your strategy is working. It will align with somebody else's strategy, right? But it might just be different explanation. Where I said that, okay, let's maybe we have something like that. We've seen a certain break of structure here, for example, okay, because this is a break of structure. All right. This right here is a break of structure. Okay. This right here is a break of structure. So we probably actually want to trade downward. All right. Now, do you know that even this ABC that we even have here, this ABC that we have here, it could as well not be ABC. It could be A, B, C, D, E, F, G. Do you get what I'm saying? Right? We could see have price keep trending to the downside. Okay. But just to present it in a simple way, right? Just take note that no matter how much of trend we have formed after we have taken structure, okay, the moment we have a new high creating a new low, right? That last high is a potential liquidity to probably validate a higher zone. Okay, that means maybe I'm coming down like this. I'm doing maybe this, like I've broken structure to the downside, and I'm assume this place already exists. So I'm breaking structure to the downside. Once I have low like this, right? High. Now this last high is a significant what's it called? Is a significant high, right? That should validate a certain base above, all right? And so a price can still even continue like this, such that this new high now is now something that price might decide to induce. So you don't know how much leg the trend will take, right? But you don't just want to make decision and just enter it once it's happening, okay? So how do you now know if you should start looking for a potential trade opportunity? Because your inducement might be another person's break of structure, or your break of structure might be another person's inducement, but it's how you follow, right, your move that actually matter. So once the last significant high is actually taken out, if we have our direction. For here, we have assumed that we have broken structure to the downside, okay? So this my last significant high, right, is a potential inducement to validate whatsoever base here. Okay, of course, the base I might want to look at might be the entirety of this zone, but it might be too large for us to want to trade. This might be too large for us to trade. Okay, it might give us like 100 pips stop loss and all. But we know that once price takes out this last liquidity, this last high, okay, it simply means that all right, it simply means that this particular high that we have here, right, has completed his move, like has completed his leg. It simply means that this high has completed his leg, and we can now confidently look for a continuation. This move has completed his leg. Once the last significant high is taken out, all right, that means we should try to look for opportunities to want to sell. Okay, now, this doesn't mean, because this can be spotted on any time frame, this doesn't mean that once price comes to induce this liquidity, there are some certain time frames where this will present itself. Immediately price induces liquidity, I'm already adding position. If price keeps trading to my zone, I'm adding more positions. If this happens on a lower time frame, in confirmation of a higher time frame zone, okay? So now let's imagine, right, that, we probably have a supply here that Kama said, okay? You know, once we have an inducement simply means money. Price wants to steal money. Once price steals that money, it has every reason to continue selling. So that's why some of us, we might have a very clear, neat order block, such that the order block even appeared on 3 different time frames. You check 1 hour, this zone covered the other block. You check 45 minutes, it covered the other block. You check 4 hours, it covered the other block. You say, no, this is a sure order block. And just before the price just gives certain kind of movement, and before you know it, price has slid you and moved. Do you get what I'm saying? The essence of price coming to this area is what is to complete this impulse move, okay? And when this impulse move is completed is when the last significant high is taken out, all right? Now, when I actually want to enter this kind of trade that has actually given me confirmation, okay, this is not my final confirmation. This is more or less like, okay, the trade is like 60 to 70% cooking, all right? Now, this same pattern that actually repeats itself here, I would love to see it on a more lower time frame, because for price to move from this point C to come and induce this point B, it is a trend on a more lower time frame that we follow it, okay? So the same pattern that happened here, okay, is the same pattern that I want to see around wherever here.
which is going to be something like this. Let me assume, right? Because let me even tell you something. There are sometimes that you might have a base here. Maybe you have a supply here. Let me draw it, because being reactive is the best. You might have a base here. I think I should color it blue. So let this blue be a base, right? And let this blue here self be a base. Okay? As much as we have this as a base here, right, we might be expecting price to just snipe and sell whenever price gets here. But there are sometimes, right, that price might even come here, right, and even still induce this base and not touch, it will induce this other block and probably not touch into this other block and actually sell. I will not be wondering, when did this sell start? How did I miss it? Now, for you not to miss out is for you to still wait for this pattern to repeat itself on a more lower time frame, which is going to be this. So the movement of this C upward on a more lower time frame, price is definitely going to trend, right? High, low, right? High, low. Now price hits here, of which price could snipe perfectly well into this other block, or even trade above it a little, right? Or even mitigate this guy up here, okay? But when I will know that this movement up here is complete is if the last significant high is taken out. That means we have a break of structure. So anyhow price react, whether price reacts from this other block or induce the other block a little, or touches this zone here, this last zone here, I don't want to care. But once my last significant high is taken out, okay, I am now interested in this trade. So this is more like a double confirmation. So you see a mirror of exactly what happened here. Once it happens again on a more lower time frame, I'm interested. And price now does something like this, creates a new low. Now, can you see that this thing that we have here that was formed, this thing that formed here, on this lower time frame, it has repeated itself here. Can you see? It has repeated itself here. So for me, Mr. Peak, after price has done this is more like final confirmation for me, right? Because price could as well just continue buying and go and even take out this high, okay? So price could, that's why sometimes you might have a perfect base here and price weaks you out, yet sells. And it might be a trade you've been expecting to sell for the past 2-3 days and be like, price just wicked me out and just started selling. You probably didn't wait for the final, and even if price takes you out, it doesn't mean you should leave that trade immediately. I told you that whenever you have a zone that you want to trade from and you are actually sure of that zone, okay, it is more or less like a wild animal. I give an example in the video I produced the last time, like let's say maybe a lion chased down a deer, right, and the lion attacked the deer and wounded the deer so dearly, okay, and the deer escaped the grip of the lion and starts running away. What do you think the lion will do? The lion will not stay back because he knows that the deer is already wounded, okay, and he will go after the pursuit again. So the fact that you have seen an opportunity in the market and you are sure that, oh, price should sell from here or should buy from here, the fact that the first trade or the second trade takes you out does not mean that that trade is invalid. No, you just need to be a little bit more patient for you to now catch a final entry. So that it don't be a case of where, oh, you had maybe $200 hit stop loss, or that $200 hit stop loss, and the next move you have trade hit $5,000 profits. So you don't give up on trade, right? So immediately this scenario here happens here. Now look at this move that went up here. High, low, high, low. When do I think this impulse will be complete? When the last significant high is taken out, like break of structure, to align with the fact that we're expecting a sell. So once we have this break of structure, price creates an inducement. Of course, anywhere above this inducement, I now want to sell. Right? So even if I even spot, I might not even spot two zones. I might just divide it into two. I might just divide these zones into two, right? Just so that I don't miss. I might just divide this zone into two, so that I'll have this as the first entry, and I'll have this up here as the second entry. And I'll have this right up here as the second entry, such that the stop loss of the first is the entry to the second. So that's why most times my entries for trades are usually like 2 entries. Okay? Such that the stop loss of one is the entry price of the other. Okay, so I might just have 2 zones because anything above this high now, right, price needs to move because it's just more or less like representing a small b. Okay, let me call it small letter a, small letter b, small letter c. So whenever this repeats itself, so let me call this small letter a. No, small letter a. So I'll call this small letter a. So immediately we have a mirror effect of what happened in the bigger time frame in terms of change of direction, right? I am interested So we're always looking forward to price taking out B as inducement. I hope we are following. So this is B. We're expecting B to be taken out, all right? And this is what? This is our C. This is this new low, okay? This is this new low. So you might not understand so many big and gigantic concepts on the chart, right? But you can actually follow the chart little by little and eventually arrive at a very good entry, okay? So once I now have a mirror effect, now this B is our inducement, okay? Because as we are going down like this is high, this is low, this is high, this is low, okay? The last significant high is most times, or is mostly an inducement to be mitigated, to be induced for price to mitigate any zone that is higher, all right? So that simply means that I'm expecting price. How do I know if this movement is complete? Is when price takes out the last significant high. So above my last significant high are my entries. So I want to enter here. I want to enter here and drive price down, or enter here, and drive price down. This is actually much safer, okay? All right. So this B here is an inducement, okay? Go and read. Go and watch my video on valid pullback, right? Go and watch my video on valid pullback. You understand what I'm talking about. What I'm talking about when I say, this movement is complete, because you don't know what is going on at the back end. So you cannot just say, this thing is break of structure, or this thing is what is liquidity grab. All right, if you don't follow the storyline to eventually know the last possible things to do, all right, so that you can actually be on the right side of the trade. So once this my ABC pattern repeats itself, right, after price has grabbed the bigger B, all right, once this repeats itself, then I'm interested in selling anywhere above this side. Price can just come and just wick this by 1 pip and start. In fact, sometimes the entry is directly on top of this line, okay, and anywhere above. And mind you, if you follow this to the lower time frame, the whole of this zone might just give you something like 15 pips or even 10 pips, whereas the whole of this zone before was giving about like maybe 45 pips or so, okay? So you want to be careful, because normally, if we even want to trade this bigger zone, we are meant to carry everywhere that is above B up to the high of A as our area to want to sell. Yes, from here to here, everywhere here, we should actually want to sell here. But it might be too big. But now we are selling from above B up to A in this smaller one, but the stop loss is now smaller, so that we can actually have good risk to reward with smaller move, right? I hope you guys are understanding what I'm actually saying here. This is a very simple narrative on the pattern that Kama is buttressing on, okay? All right. So this is actually very, very, very simple and very, very basic, all right? So there are some videos I'm actually going to repost on the group for you guys to actually go and rewatch again, okay, so that you can actually grab the whole concept of this thing. And I'm just trying to talk around what my guest actually gave you, okay? Any guests that I actually bring on board, all right, I'm going to try as much as possible to buttress on their points based on the knowledge that I also have on the chart, because people that I invite are like mine. These are people that we have talked before, or like we have the same thing almost going on in our sphere. So I would definitely have an idea of what they're talking about and how to put it out there clearly. So this is the one very basic concept that you actually want to be familiar with, all right? Okay, about inducement or maybe valid pullback, so that you can know what we're actually doing part time, to know exactly when things want to happen, all right? And of course, I still said something about we paying attention to demand and supply, okay? Paying attention to demand and supply, right? Such that we don't miss out of when a demand is violated, and we now have to locate the supply that caused the violation of that demand, and so on and so forth, okay? And I said every potential low, even if you are targeting that low as a liquidity, right, the base around that low is a potential zone, okay? We can see that what happened here. We can see that price actually took out this low, for example, that was probably meant to be respected. Price took out this low down, okay? And this is actually a signature move. Price engineers liquidity. Now, the only time I might want to buy from B, this is the only time I might want to buy from B. Let's say price did something like this. if price does something like this, price does something like this, okay, this is the only time I want to buy. Okay, let's say we have something like this. All right, now I'm just trying to mirror what is actually here. All right, we have a confirmation. Okay, we have a confirmation to, or we have a 50% confirmation that we are selling because we have broken structure. Price has induced B. Okay, so we might want to sell from anywhere above C. I mean above B. So I'm taking this illustration right here as this big C to A. I mean big capital letter C to small letter A. Okay, so look at this zone here. This zone that I have here, the only time I might want to be interested in buying, I mean selling from B, is if price gets to B, reacts from B, then now use it to break structure. For example, something like this. Okay, let's say maybe this is the low. This is the low before A. So let's say this is the low before A here. Okay, the only time I might be interested in selling from small b is if price does something like this. Price comes, okay, price comes here, reacts from this low that created small letter A, react from this low, give us a high, right? Then break structure. Okay, you can see price reacted from this demand. In this one, price broke the demand, created liquidity, created a new low. Here, price came, all right, tap into the demand. That is, demand respected a little, right? Then price down violated it, okay? So I might actually be interested in what? In selling from here, okay? Because I know that, oh, this demand actually pushed price. And price wanted to respect the demand. But of course, price took a U-turn to now violate everything, to now violate both this area, both this little demand that is here, and the main demand it tapped from. So I might be interested in selling from this high, no doubt, which was something that I did in my last Euro USD sell, okay? Price mitigated this, can mitigate this, and I'll just sell. Okay, we might not have any significant high around here, or you might just notice a little range movement. You might just notice a little range movement. Everything there will just be liquidity to validate a certain supply that you probably have up there. So the only time where I might be interested in selling from B is if B reacts from a demand or reacts from a zone, reacts very well, right? Okay, then now violates the zone. I might actually sell from B, such that I might not just see here as inducement. And if price comes to take it as inducement, who am I to argue with price? I can still take above it. But at this point, I might want to be interested here. But once price takes it out, creates a high, creates a new low, I am definitely going to trade above this B. But if price trades from this demand here, gives a push to the upside, and now breaks all, I might be interested in selling from B or anywhere above B. Please, do you understand this basic and simple thing that I'm explaining right here on the board? Please, if you understand, just do as if you are asking questions. Let me just see the reactions as if you want to ask questions, if you are understanding what I'm doing. All right. I can see that you guys are understanding what I'm doing, okay, which is very, very good. All right. So, in fact, this thing here was something that I did in the Euro, the GBP USD. I don't want to show too much on the chart because I think we have done up to an hour, all right? And I said it's going to be a regular program, okay? So, okay, for example, if you look at this is actually in the video that I posted. If you look at this entry that I actually have here, okay, I think I explained all this. But look at this area where we had a failed demand here, because I wanted to buy from here, because this immediate trend upward, this red zone, high and low, high, higher high, this higher low, higher high, even though we are still this, within a control supply. Now, I tried to buy from here. What happened? Price reacted from this demand, traded upward, okay, before coming to break it. So I was interested in buying here, selling here. Because this was meant to be my B, okay? This was meant to be A, B, C. This was meant to be, this is A. This was meant to be like A, right? B and C. So I was actually meant to maybe come and sell above B to drive downward. But the reason why I didn't was because the demand, the control demand at that point, first of all respected, pushed to the upside before coming to violate. So any little range in between that movement, I might just term it as the liquidity. So all this thing, I just termed it as the liquidity, and I just targeted the base that came to clear the demand. But if not, I didn't price this something like this, right? I didn't price this something like this is A, right? If price had done something like that, this is A. Let's say maybe this is A. Price broke the demand, created a B, created a low. Then, of course, I want to trade above this and drive downward. Okay? So for me to know when this movement down here is complete is when this last significant high is taken out and the base here I want to sell. Okay? But the fact that price respected this demand, right, before taking it out, I can be interested in selling from B as well. And if price takes me out here, once it gets to this region above B, I enter another position and put stop loss above here. Okay, you have to ensure that you don't see yourself as too perfect on the chart. You have to be to a certain level, be vulnerable. Do you get what I'm saying? Be able to see yourself that you might be wrong. All right, and if price moves in certain way that violates you, okay, now switch up your idea, switch to the other kind of variables that can be present, okay, in that particular analysis, and actually trade it. Do you guys understand? I hope you guys are following this thing that I'm giving to you, right? This free content. I have over 108 people here. I can decide to monetize this thing and you guys will pay because we are spitting out facts. We are spitting out sincere understanding of the charts. Do you get what I'm saying? But this is just me trying to, as much as possible, like I said, trigger your battery so that you can drive your vehicle by yourself, okay? But as if your vehicle is still not moving, then you can now come and subscribe to a mentor, of which there are so many good people online, and ensure that you subscribe to someone that will see you through. But if not, some of these things are enough to give you that push that you need, okay? So that when you go and check chart again or go and check things again, you will see it in what? In more different lights, in new lights, all right? In new lights, okay? So let me just actually stop here, okay? Let me just stop here. All right. So in the next in the next Let's Chat episode 3, I might be bringing another of my friends too. Okay. I could be bringing decision point trader or liquidity pool trader, LPT, all right, to further come and tell us some things. It might not now be on entries, it might now be on some other kind of topics, but I just want you all to be getting this little stuff to keep pushing you. And if you now need broader or proper mentorship, you can now subscribe to anybody that your spirit and leads you to online, all right, which is very, very important. So I'm going to give access to just 2 or 3 people to ask question, right? So if you want to ask question, right, just click that you want to ask question. I'm going to give 2 or 3 random people ability to ask question, okay? And take note that the fact that we are talking like this does not mean that we are immune to losses, okay? Does not mean that we are immune to losses. In fact, this trade that I closed today, I did 21 hours on this trade. But let me tell you something. I took this trade with 2 lot size. When price did 10R, yeah, I closed 1 lot in one of my accounts, right? I closed 1 lot here and I left the rest. So even if this had even come back to my break even, at least I've covered 1 lot, or I closed maybe 1 lot on that particular account. But since it didn't, price still further went to final targets. All right. So what's the beauty of you analyzing something and price doesn't get to your target? And even if it doesn't get to your target, it doesn't mean that you should not have profited from the trade. Okay. So let me just give 2 or 3 random people ability to ask questions. So if you want to ask questions, just click the allow to speak. Let me give some people randomly. Who can I give? Who can I give here? Who is Crown Wealth? Is it Crown Wealth or should I like Crown Wealth? Are you ready to speak? Based on what you have heard today, okay, you can actually ask whatever you want to ask. I can hear you.
Are you there? Crown Wealth, I've allowed you to speak. Okay, Canwell is not there. Let me give another person. Who is Young Bishop? Canwell, can you hear me?
Yes, I can hear you, sir.
Yeah, what's the question?
Good evening, sir. Firstly, sir, I would love to say thank you to Mr. Big Kama and for this kind of opportunity. It's a really push up for us, sir. Now, my question goes to sir. When Mr. Big Kama was giving us some explanation, I don't know, maybe he actually finished up the discussion because at that period my network got disconnected while he was talking about the inducements. He was talking about the inducements. I don't know if we can actually go on that again for us again, sir. Then two, that's one. Then two, also again, if he made mention of something that a supply zone is a decision point. We always have to wait for a price to react, then we decide. If the supply zone happens to be on our order block, whereby it's giving us another order block with a valid order block, do we need to wait for price to decide first, or we still just go ahead since it's giving us a clear confirmation on our entry?
Now the thing is, right? You know that analysis is done from higher time frame down to lower time frame. Okay, price is actually fractal. Whatever forms on higher time frame, right, can actually also form on lower time frame. But it's just that structures that are formed on higher time frame are stronger than structures that are formed on lower time frame. So the structures from a lower time frame is just to align with what has formed on the higher time frame to move to the higher time frame destination or targets. Do you get what I'm saying? So just like what I was saying, that if price has actually given you something like this on a higher time frame, anywhere above B is valid to actually sell. But imagine you spot this on, let's say, maybe 4 hours. From this B to this A can give you like 175 pips. Who wants to trade that? Do you get what I'm saying?
Yes.
That means this B is 175 pips and you take your sell. That means for you to even make 1:1, you need to have a 175 pips profit target, which can be too much. So you need to wait for price to now give a more lower time frame confirmation so that your stop loss can be reduced from the 175 pips. Your stop loss can be reduced like maybe 20 pips, so that you can maybe be out by 80 pips and make 4 hours. Because you making 80 pips from this zone up here, you might not even make up to 1 hour because your stop loss is 175 pips, because you have to apply risk management as well. Do you get what I'm saying?
Yes, please.
So even if you have a clear supply, if that supply is on a hard time frame zone, and to give you a very big stop loss, right, such that you will not even be able to calculate your what's it called, your risk to reward properly to have something good. Why not just wait for price to induce the necessary thing that it needs to induce, which is maybe induce B, okay? Now react to somewhere around above B, okay, which could be this point, maybe a supply close to B, or maybe the extreme, this capital A here. Then you now need to wait for price to give a more lower time frame, because price cannot just come to a higher time frame zone, snap it and start jetting. No. There must be footprint on how to enter on the more lower time frame. And if price doesn't give you footprint on a particular trade, then wait for next opportunity. That's when sometimes you get that, I knew it was going to sell here, but I didn't see entry, which is not bad. Forex is not ending soon. Okay?
Yes,
do you understand?
sir.
All right. So my advice is that you're going to rewatch this video again to get further understanding, and also get across to maybe some of the videos I have on my YouTube and have a perfect understanding. But hope you understand what I'm saying.
Yes, I do.
All right. Thank you very much for your question. Yeah. All right. One more. Let me give opportunity to Trey. Who is Trey? Trey. Let me allow you to speak before we end this session. Please take a screen record, screenshot, ensure you tag me and Kama and just say something nice on IG and even on Twitter. All right, very, very important. So, Trey, you can speak. Trey. Hello, Trey.
Hello?
Yeah, I'm listening to you. You can speak.
Yes, thank you everyone for the opportunity. Mr. Peak and Mr. Kindamola. I just have a question about risk management.
Risk management. That is what I plan for us to do. That's what I plan for us to do in the next class, right? With the person that I want to invite, but I can hear your question.
Okay, so Akindamola was saying something about the last base demand before it gets its Fibonacci, then looking to sell. Yeah. So I was looking at if it reacts, and you said if it reacts from that place, then drop. That supply now, that new supply now is you can enter from there straight. But what if our risk management, come to risk management, what if we buy from that demand zone, then wait for the sell opportunity to come in?
What if you buy from which demand zone? Can you indicate with what I've drawn here? Just say, okay, maybe the demand before capital small letter A, or the demand, just use it to annotate so that we know exactly what you are saying.
Okay, yes, from the small letter A, the demand from that created the small letter A.
Okay, this demand here, yeah,
Yes.
Okay.
Yes. What if we see something like this like normal buy, then inside the lower time frame, then we take a buy from there, and
you see something like okay, as price was coming down, right?
Yes,
price maybe tap into the demand, right?
Yes.
Does something like this, does something like this, does something like that, come to mitigate.
Yes, and we bought from there. Is it good to buy from that place and like take
Of course you can. There are sometimes, where me personally, there are sometimes that both buy and sell can look so very clean to me, right? That I will buy, okay, once I see buy confirmation, and sell once I see sell confirmation, and break even on both. Do you get what I'm saying? And allow price to react. Do you get what I'm saying? But at certain point in time, you need to just be identifying control supply and control demand, right? And see whichever one is taken out and see whichever one is now intact. Do you get what I'm saying? Because for that GBP-USD trade that I told you that I actually took that buy because the stop loss was actually reduced enough. Let me show you. I took that buy. I took this buy right here. I took this buy.
Yes, exactly. That's what I'm talking about.
So the stop loss was reduced. I think it was about like 10 pips or so because price did 28 pips. Took me out. Then I know that okay, this is now the bearish intent. So I now sold. Because this was valid, okay? Now, this supply has not been taken out, so it's still valid. If price is approaching a supply, it is demand on that flow that will sustain it there. So the last significant demand is the control demand. It can take out the supply. Price can do this. Price can react to this, take out this supply, right? Then I can even enter a major entry, then now go upward. Okay?
Yes.
Do you understand what I'm saying? But immediately price reacted to this, right? My entry was still open and price came here, take it out. I'm like, okay, we have now switched to sell properly now. So it is not bad to take hits sometimes. You have to take hits for the team sometimes. It is not a bad thing to hit stop loss as much as you have planned or anticipated it. I've told you that professional traders, right? They look at what they will lose before they enter a trade. But intermediate traders who don't have sense, they look at what they will gain before they enter a trade. So it's two different things. So that means a professional trader has planned for the loss, even though he's expecting profits. But a greedy trader has planned for profit that this thing 60 pips, make a don't knock and 16 lots. $16,000. He's looking at the profits to set what's it called, lot size. But professional trader knows that okay, there's variables or there are variables. This could hold and this might not hold based on what price has formed. Okay, let me go with this risk. And once price takes me out, I can now go with this risk to recover this and now leave this to final target and so on and so forth. Do you get what I'm saying? So you just need to be open-minded to what price wants to do. Do you understand?
Yes.
All right. So I think we've done close to an hour here, right? This recording now is 1 hour 19 minutes. So I'm actually going to stop here. Okay. Please, everybody, take a screenshot now, right? And if you have recorded videos of when Millie Kama was talking, if you still send me a message now, right? Please go to Twitter, maybe under the post that I posted maybe today or maybe under the post of this left chat that I posted today to remind people. right? You can actually go and maybe tag us there and just maybe say something and thank us, or also go to your Instagram page, upload whatsoever picture or video that you have recorded, tag me and tag Kama so that we can actually post, okay? You can also get good values from our groups. You can join Kama's group, right? It's general general Telegram group. You can also join mine. Then also YouTube channel. Go and watch videos there and try to understand, right? And try as much as possible to try out all these things and ensure that you put in your work to make yourself profitable and be consistent with it, right? So thank you all very much for attending tonight's class. I appreciate you all. Okay, have a wonderful night. Bye-bye.